Allstate just generated $63 billion in revenue last year. That's more than Netflix, Starbucks, and Nike combined. Yet most retail investors couldn't tell you a single thing about this company beyond their insurance commercials. Today I'm breaking down exactly why this insurance giant deserves your attention. Two compelling reasons to consider buying all stock, and one significant risk that could change everything. Let's get into it. Reason number one. Allstate has built a fortress that competitors simply cannot breach. Here's what I mean. In the property and casualty insurance space, Allstate controls the second largest market share in the entire United States. We're talking about over 16 million households protected. 16 million. That's not a customer base. That's a small country. But here's where it gets interesting. Insurance isn't like tech, where some startup can disrupt you overnight with a better app. Insurance requires three things that take decades to build: regulatory licenses in all 50 states, actuarial data spanning generations of claims history, and brand trust that only comes from paying out when disaster strikes. Allstate has all three. They've been doing this since 1931. That's 94 years of data on every flood, fire, car accident, and natural disaster imaginable. You cannot download that from the cloud. You cannot raise venture capital and replicate it. This is a genuine economic moat, and it gets wider every single year. Now let me stop you right here because I know what you're thinking. Insurance sounds boring. It sounds like a slow-growth grandpa stock you buy and forget about. And 5 years ago, you might have been right. But look at what happened recently. Allstate's stock price has nearly doubled since 2023. Not some speculative AI play, an insurance company. Why? Because when inflation spiked, Allstate did something most companies can't do. They raised prices, and their customers stayed. That's pricing power. That's what a moat looks like in the real world. Reason number two, and this is where income investors need to pay close attention. Allstate is a dividend machine with a track record that demands respect. They've paid consecutive dividends for over 30 years. Not just paid them, increased them. We're talking about a company that has raised its dividend through recessions, through market crashes, through global pandemics. The current yield sits around 1.5%. Now I can already hear some of you saying, that's not impressive. And you'd be missing the point entirely. Allstate's payout ratio hovers around 20%. That means for every dollar they earn, they're only paying out 20 cents as dividends. The other 80 cents, that's going back into the business or staying on the balance sheet as a safety net. This matters because when the next crisis hits, and it will hit, Allstate has the cushion to maintain that dividend while other companies are slashing theirs. Conservative payout ratios aren't boring. They're insurance for your income stream. The company has also been aggressively buying back shares, which means your slice of the pie gets bigger every quarter without you doing anything. All right, now here's where I have to be honest with you, because everything I've said so far paints a pretty picture. But there's one risk that keeps me from pounding the table on this stock, and if you're seriously considering a position, you need to understand this. Catastrophic weather events are becoming more frequent and more expensive. This isn't speculation, it's in Allstate's own financial filings. Hurricane Ian alone cost the insurance industry over $50 billion. Wildfires in California, flooding in the Midwest, tornadoes where there never used to be tornadoes. In 2022, Allstate actually posted a net loss. The biggest insurance company in America lost money because catastrophe claims overwhelmed their premium income. They've recovered since then, and they've raised premiums aggressively to compensate. But here's the uncomfortable truth. Nobody knows if those premium increases can keep pace with climate risk. This is the fundamental uncertainty baked into every insurance stock right now. Allstate is pricing policies based on historical data, but what if the future doesn't look like the past? What if 100-year storms start happening every decade? The models break. The math stops working. So where does that leave us? Allstate is a high-quality business with a defensible moat and shareholder-friendly management. For investors who want steady income and can stomach volatility during catastrophe seasons, this stock absolutely deserves consideration. But if you're looking for sleep-at-night safety, understand that climate risk injects uncertainty that the market hasn't fully priced in. My take? I'm watching this one closely. At the right valuation, the reward justifies the risk, but you need to size your position appropriately and understand what you're signing up for. If this analysis helped you think differently about insurance stocks, subscribe to the channel. I break down opportunities and risks like this every single week so you can make smarter decisions with your money. Hit that subscribe button, and I'll see you in the next one.